I'm here to discuss the Investment Boost announcement with BDO tax experts Mark Lodder and Iain Craig. Hello to you both.
Hello. Hi, Madison.
Iain, can you please start by explaining what this is, when it was announced? Give us all the detail.
Yeah, well, it was announced on budget day, which is quite unusual for a tax policy to announcement. It was a bit of a surprise, but a welcome surprise, because here was a very positive announcement that for people who are buying new capital expenditure or plant and equipment, productive depreciable property, they were going to get an instant 20% tax deduction and also be entitled to their annual depreciation as well. So the whole idea is to try and boost expenditure and get companies to invest in their businesses in productive assets, and hopefully that will be good for the economy.
Mark, it's effectively accelerated depreciation, but how do they calculate it? How does this rule actually work in operation?
That's right, it's accelerated depreciation, exactly that. So basically the cost of the asset, so you might pay $100 for an asset, take 20% of that, $20, that's your tax deduction, that's not cash coming back to you. So then that's taxed at or a deduction at your marginal tax rate. So if you're a company, it's at 28%, so on and so forth. But fundamentally, 20% of the cost, and then as Iain said, you get to depreciate on an annual basis as normal based on the net amount. You don't get depreciation again on the gross.
Are there any purchases that are excluded?
So residential properties out, fixed life intangible property is out, but the big one that's in is commercial buildings. So you can claim the investment boost on commercial buildings, which is a bit of an oddity because we talk about accelerated depreciation, but we don't get depreciation claims on commercial property, of course, but we do get the investment boost. Other things to think about that are in rather than out: seismic strengthening, if you're making capital alterations to buildings, etc.
Alterations, that's interesting. So if you make improvements,
extensions,
this is all included?
Yeah.
Fascinating. Iain, has this changed business owners' behaviour at all, given that it only came into effect this year, or in your mind, should it?
Yeah, I think there's a lot more questions being asked about what they should do and should they spend the money and will they be entitled to this? And so it applies to new depreciable property that's being acquired after the 22nd of May 2025. So it came in instantly on budget day. So if you bought something after that day and it became available for use, that was great. It can also apply to second-hand goods if you're bringing them in from overseas. So because it's never been used in New Zealand. And there'll be some people who were already committed to capital expenditure and their programs, and they've effectively got a windfall deduction because they didn't expect to get as high a deduction at 20%. So I think, so that's one thing. So when you've already been committed to that expenditure, it hasn't resulted in a change. But as we're heading towards 31 March, there is a real ability to sit there and go, okay, what is my tax payable looking like for this year? And should I buy something before year end that is available for use before year end and able to get a deduction at 20%? So I could reduce my year end tax bill by buying myself a new camera or a new
which I have
microphone,
just done, Iain.
which you've just done. So, or the famous, look out for a lot of sales of tractors in the farming sector in March.
Utes.
And utes, maybe, subject to the FBT rule.
And this was the whole point of the policy, wasn't it, Iain, to boost spending in the economy from the business sector?
Absolutely. It was designed to it's an investment boost. It's there to boost spending on New Zealand and to build productive capacity, get businesses that were lacking confidence to actually make a commitment to invest and grow productivity by buying some more tools. And, that could be, I think that could also have been stuff that was in progress but hadn't been released before 22nd of May. So imagine if you were building a software program it was in development that you would use in your business and it didn't become available for use because you didn't get it completed until September. You're going to get a 20% deduction on that, which you wouldn't have been expecting. So there'll be some auditing around that threshold at the 22nd of May. We can't expect to just do an accounting entry where I release my construction in progress in June to the general ledger and say that's when it became available. It's all about when did it become available for use, rather than when did the accountant release the cost out of the general ledger. So I expect some IRD audit activity and reviews of those claims. But yeah, it's a self-assessment. You should be entitled to it. Keep the evidence that as to when use came in.
Well, this was such great detail. Thank you both so much.